Let's talk about the broader markets and investor efforts to try and navigate all this volatility that's been unleashed by Russia's invasion of Ukraine. Joining us right now is Jeremy Siegel, who is professor of finance at UPenn's Wharton School of Business. And Jeremy, I just want to get your thoughts based on what we were just talking about with Steve, with Rick before that. I mean, the Fed's signaling yesterday, Jay Powell saying that it's going to be 25 basis points. Obviously, they're watching to see what happens in Ukraine and with Russia to see whether they should be taking this more slowly. How does that play into your thesis, which is that the Fed's already been behind and that inflation is going to be stronger than a lot anticipate, be there longer than a lot of people anticipate, and require the Fed to do even more?
Yeah, and I actually think it would be a big policy mistake to slow down because of the Ukraine. I mean, we had this situation in the 70s with oil prices going up, and Arthur Burns was chairman of the Fed, and he decided also, well, the economy's contracting, let's put more money into the system, and that proved to be a huge policy error. Unfortunately, you've got to take the medicine, and I'm very disappointed. I think the Fed should go 50 basis points. The first time in March, he did open the possibility there would be more. I actually think the 5.5% to 6%. Steve mentioned that hikes that they're going to have to do much more than that. And I'm actually disappointed that that Chairman Powell did not look at the history, saying that this is not a time for us to slow down. And I think he will come to that realization. I was also disappointed, by the way, that he said that, we really didn't formulate a plan for the draining off the balance sheet. And that disappointed me, too, because that is also very important. I mean, I spent an hour actually interviewing Fed President James Bullard from St. Louis last Friday, and he said we got to be at least at 1% in July, and implied we got to be probably at 2% or more by the end of the year. Although I'm willing to look at what that situation actually is. He's on the committee. He's a hawk. He could dissent. I don't think he will the first time. He said, I'm willing to give 25 basis points the first time, but he said we're going to have to do 50 basis points after that, and I think he's perfectly right.
Hey, Jeremy, Jay Powell is no Arthur Burns. I mean, he has a much better grasp of the markets, a much better understanding. And I have to say, listening to him yesterday, I like listening to him. I feel like he's in command and control. He gets these things. He's also pretty smart about how he says things politically. May not be ready to shake the markets and say we're going to do this pretty steadfast with all of these rate hikes coming through. I didn't get the sense listening to him that they are going to go that much slower. To me, kind of reading through and listening to hours of that testimony yesterday, it sounded to me like, he knows that this is an issue. He knows that they need to be moving on this, and he's not going to say anything to shake the markets up right now. But that was just my interpretation. How about yours?
Well, certainly we saw when the 2-year rate went up 18 basis points, when he opened up the fact that we're going to have to go faster. I think that the market said that. But we also have to admit, Becky, that the Fed has been terribly wrong over the last year. I mean, all this temporary inflation. Look at their projections for inflation that they did last year, so way below what actually happened all the way to December. And listen, Jay Powell is a very, very good man. He's a good communicator, but the Fed has been very wrong, and they're going to have to catch up, and they have to and really have to admit, we got to bite the bullet here. We got to defend the dollar here. We talk about Bitcoin taking over. We got to defend the dollar.
If they do 25 basis points in March, I think May is the next meeting, and then June, and kind of move through in 25 basis points, you could be talking about a full 100 basis points by the time you get to July.
I think you need at least one meeting on that. But also think about 100 basis points in an inflation that is 5%. And by the way, on March 10th, when we get the CPI, it could hit 8%. on a year-over-year basis. Is that really tight? History tells you, no, that really isn't tight. And, we had gone up to 2% with a balance sheet half the size with no inflation. And now we're so scared to go above 1% with 8% inflation and a balance sheet that is twice as large. You got to be more aggressive.
Let's talk about the market implications of this. Whatever the Fed does, if you're talking about this hotter inflation and talking about the Fed moving maybe not as aggressively as you like, we've seen the stock prices come down pretty significantly since the beginning of this year. Not a free fall by any stretch, but prices are down. Does any of this look like a bargain to you? And if not, what would it take to make things look like, okay, this is a time I would buy?
Well, I think long term, you're perfectly right. I mean, we're selling under 20 times earnings for the S&P right now. And in an environment of low interest rates, even a rising interest rate environment, that is that's very, very cheap. I mean, if you take out the tech sector, you're selling at 17, 18 times earnings. I mean, given the interest rates, this is a good long-term buy market. However, with the Fed, as I believe, we're going to have to be more aggressive. It's going to be a rocky 2022 market. Right now it's sort of, I think yesterday we saw the market go up, party on. He's not going to do 50 basis points right away. We're not going to take our medicine right away. We're going to have to take it a little bit later. It's still a good long-term value. VIX over 30, by the way, has always been a good long-term value. Sure, it could get to 40, 45. We could get a downward spike. But long-term investors should certainly stay very, very much invested. I still believe the pivot will be towards the value stocks because a more aggressive Fed, which I think they will have to be, will raise those interest rates, discount the long-term cash flows more, and certainly hurt those long-duration stocks. But nonetheless, for long-term buyers, this is certainly not a market to flee from.
Professor Siegel, I think that's a pretty important distinction. There are so many concerns about inflation, what's happening in Ukraine, and other issues. Markets sold off because of all of those reasons. And if you're saying that prices might get cheaper from here, that's one thing. But if you're in this for the long haul, you think this is a place to buy, and that's probably worth really emphasizing.
Absolutely, yeah. I mean, you're nowhere near the type of craziness that we were 2 or 3 months ago, and nowhere near. People had compared it with 2000 when we were at a 30 to 35 PE market, when you could get those tips real returns of 4.5%. Today, those are like minus 1%. The alternatives are just so low that stocks are definitely the place to be for the long-term investors and for people wanting to protect against inflation. They are claims on real assets. And that's an advantage.
Yeah, in an inflationary environment, cash is trash. Professor Siegel, thank you. Great to see you.
Thank you very much, Becky.
It's interesting. So he thinks the Fed is going to continue doing this with small increasements, which I'm told is incremental increases. Twitter is good for some. Twitter is good for some. Some guy's wife came up with increasement. And why is that not a word? There's an incremental increase. Then we don't need to explain it. We don't need to say 50 or 25. It's an increasement. Up next.